Let's begin the amendments on income from other sources. In income from other sources, we totally have 3 amendments. 2 amendments are given under supplementary material. Like it's not, I can say amendment, it's a CBDT clarification on computation of exemption under 1010D, 10 clause 10D with respect to amount received under a life insurance policy. Getting it? How to calculate exemption, especially if you are able to recollect the provision where if the insurance premium paid for any previous year is exceeding 5 lakh, that insurance policy is not exempt from that insurance policy is not exempt. Accordingly, maturity procedure is fully taxable. I hope you are able to recollect. Getting it? So regarding that, CBDT has given a very big clarification, and I'm telling you, for sure a question is going to come on 10 clause 10D. For sure, I'm expecting a question might come on 10 clause 10D because they have given 10 problems. In the supplementary material, they have given 10 problems on 1010D, either as a single adjustment you might get or as a dedicated problem you might get. Even at CF final also, this is one of the important amendment for CF final direct tax students. Getting it? Now, and another amendment that we got in Finance Act 2023 is winnings from online games. So winnings from online games, there is a separate section 115BBJ has been introduced, and corresponding 194BA, there is a separate TDS provision is also introduced for that. So we are going to discuss all that. And most importantly, in other sources, now there is a specific section which is inserted, 56 subsection to clause 13. In the ICS study material, it is wrongly printed as clause 12. Clause 12 is talking about ULIP taxation, maturity amount from ULIPs. Clause 12 is not there in our syllabus at CA. Inter ULIP related taxation is not there. But in the ICA material, for life insurance policy maturity, they wrongly referred it as clause 12, but it's actually clause number 13. 56 subsection to clause number 13. Yes, these are the 3 amendments we are going to discuss. Now, straight away, let's look at what is the amendment exactly is talking about. Now, so there is a there is a notes like this which is available. I'll give you, you can directly download this particular notes from our website. So in the below comments in the YouTube video, if at all you're watching, in the comments the notes link is given. So you just directly click on that link, you'll be directed to our website. You can download that material. Okay, this notes you can download just 2 pages notes. Now we all know. So what I'm exactly trying to talk about is, I'll open this material by the way. So winnings from online games, I'll get back later. Okay, first I'll straight away discuss on 10 clause 10D. What is 10 clause 10D actually talking about? First of all, what is taxable under income from other sources? 56 subsection to clause 30. As per Finance Act, any sum received, if at all you are receiving any amount, including bonus, generally whenever insurance policy matures, you will get sum assured plus bonus also you'll be getting. So whatever it is, whatever the sum assured and bonus, whatever you are receiving under a life insurance policy other than ULIP and other than Keyman insurance policy, because clause number 13 is dealing with life insurance policy, not ULIP. ULIP is dealt under clause number 12. And Keyman insurance policy maturity amount is always taxable. 10 clause 10D. If you look at 10 clause 10D, it straight away says Keyman insurance policy is taxable, which is not exempt under 1010D. If at all you're receiving any sum from a life insurance policy which is not exempt, that life insurance policy, that amount so received, getting it, would be chargeable to tax under income from other sources. Now, how much is chargeable to tax? The sum so received exceeding aggregate premium paid for which you have not claimed any deduction under the provisions of the law. Fine, let me keep this aside little while later. First of all, which policy is taxable? That policy which is not exempt under 10 clause 10D. Remember, I am explaining the entire provision 10 clause 10D. I am also covering ATC point. I am also covering 194D, a TDS provision. Entire insurance policy related taxation I'm going to cover in this video. If you watch this, I'm telling you, you have learned, TDS provision on the same, other sources provision on the same, exemption of the same. Getting it? 3 points I'm going to talk about on the same point. So fine, I'll talk about this brown color highlight part later. So if a policy is not covered under 1010D, if you're receiving any amount from that policy, that is taxable under other sources. This is what through clause number 13 they specifically clarified. Even before Finance Act 2023, this clause is not there. At the time also we tax it under income from other sources, but we tax it as a residuary head of income. Now there is a dedicated clause. There is a dedicated clause which says this income is always taxable under income from other sources. Fine. Now let's look at actually what is this 10 clause 10D is actually talking about. So straight away, you can use this diagram for a simplest understanding purpose. 10 clause 10D. 10 clause 10D. We all know section 10 is talking about exemptions. Section 10 is one thing which is talking about exemptions. Exemptions for what? Exemptions for amount received under a life insurance policy. Amount received under a life insurance policy. For a life insurance policy, whatever you have joined earlier, if at all you are getting any sum, any money, whether you call it as maturity, whether you call it as surrender value, whether you call it as bonus, it doesn't matter. It doesn't matter. So maturity, surrender value, bonus, whatever amount you are receiving from a life insurance policy is exempted if at all it falls under any of these three categories. If at all it falls under any of these three categories, it is exempted. If at all it is not coming under these three categories, it is straight away taxable. Now look at it. Suppose if at all you have purchased the insurance policy on or after 1st April 2012. If at all you purchased insurance policy on or after 1st April, actually there is one more date. On or after 1st April 2003, but before 1st April 2012. After 2003, before 2012, that column was also there, but now it is not relevant considering those policies and all were expired. That's why I'm not taking those policies references. Okay, straight away. But in the material, no, I gave even that also. Before 2003 picture I gave, after 2003 picture I gave, after 2012, after 2013, and even now the latest amendment after 2023. This is Finance Act. This is Finance Act 2023 amendment. Getting it? On that, in the supplementary material, they have given 10 illustrations how to apply that amended portion, how to apply that Finance Act 2023 provision. They have given 10 illustrations. We are going to discuss all that. So what are they saying? So if a policy is issued on or after 2012, but before 1st April 2013, if the premium paid for any previous year, premium paid is there, right? Premium paid means what is this premium paid? Premium paid for any previous year. So during the term of the policy, suppose each policy might have a term of some 5 years, 3 years, 10 years, like that. Every year, how much premium you are paying for every previous year? Getting under income tax, we only see previous year wise. So in a previous year, for a particular policy, how much premium you paid? Check out. Okay, so and so amount you paid. What is that amount as a percentage of sum assured? So what is the sum assured? You see, what is this amount to percentage? Premium paid percentage of sum assured. If at all the sum assured, if the premium paid is less than or equal to 10% of sum assured, that policy is treated as an exempted policy. And moreover, you know very well, up to 10% of sum assured, whatever premium that we are paying for a policy that has been taken on or after 2012, but before 2013, you can claim 80C deduction for the premium paid. Whatever premium that you are paying, you can claim deduction. Moreover, the premium paid is not exceeding 10%. Getting it? That insurance amount is also exempted. When, if at all you have taken the policy between this year, 2012 to 2013 year. Suppose, I have taken policy after 2013 only, and I am not having any 80U or 80 DDB disability. I am not having, the SSC is not having any disability or any disease given under 80U or 80 DDB. Same 10% only. So for an SSC who is not having any disability or disease, getting it? If at all he has taken a policy on or after 2012 or on or after 2013, it doesn't matter. 10% of the premium is the cutoff. 10% of the sum issued is the cutoff. If the premium paid for that policy in a previous year do not exceed 10% of the sum assured, that policy is exempted. Suppose if at all the policy is taken on a disabled SSC, or if the policy is taken in respect of a deceased, in respect of a person suffering from 80 DDB diseases, specified diseases. Suppose if at all he is having any disability or if he is having any specified diseases, then up to 15% of sum assured excuse is given, relaxation is given, because generally for handicapped people, disabled persons, people suffering from diseases, the insurance premium is generally higher. Getting it? So compared to normal people, that's why for exemption also the criteria, for exemption criteria also, they have increased the percentage. Now, this for disabled people and all, the percentage is 15%. When, if the policy is taken on or after 2013. Suppose there is an SSE. He is suffering from disability under 80U and he took a policy on 1st July 2012. What is the percentage applicable? 10% only. Because 15% is applicable for a disabled person or a person having specified diseases. 15% logic is applicable if the policy is taken on or after 1st April 2013. Now remember, whether he has taken policy here or here or here, whatever it is, up to 10% or up to 15%, he can claim deduction under ATC. Whatever the premium that he is paying, he can claim under ATC deduction. Moreover, if at all premium is less than or equal to 15, less than or equal to 10, less than or equal to 10, means premium payable itself do not exceed 10, itself do not exceed 15. Straight away the policy is exempt. If the annual premium payable do not exceed 10%, 15%, straight away the policy is exempted policy. When you are receiving maturity, that maturity amount is also exempted. This is the amendment. This is the provision which every one of us know, because this provision is there from long ago. Now, in the Finance Act 2023, they have added one more provision. If at all there is an insurance policy, issued on or after 1st April 2023, issued on or after 1st April 2023, and premium payable for those policies is not exceeding 10% of sum assured for normal SSEs, not exceeding 15% of sum assured for 80 DDB SSE or 80U SSE, 80U or 80 DDB SSE. If the premium is not exceeding this, even those policies are also exempted, provided this proviso is what added in 1/4/2013 onwards. A proviso has been added. The point is very simple. There are many SSEs who are, especially high salaried individual, high net worth individual. What they're doing, you see, very simple. Now they are claiming optional tax regime, especially high salaried individuals, high net worth individuals, salaried employees, especially this is very popular. Some high paid employees where their monthly salary is 10 lakhs to 15 lakhs. What they're doing, they are happily going with default tax regime. They are going with the default tax regime under 115 BSE, and they are paying tax at very consistent rate. Even though their yearly package, yearly salary is 5 crore to 10 crore or more than 10 crore also, they are happily paying surcharge at maximum 25%. They're enjoying all the benefits under 115 BSE, and they don't even claim ATC deduction and all, because ATC 1.5 lakh deduction is not a big deal for them. 80D maximum deduction is how much? 50,000. That is also not a big deal for them. Yes or no? So these are all not a big deal. So they don't claim any deductions under Chapter 6. They straight away go with 115 BSE. These people, what they are doing, they take big life insurance policy. So some life insurance policies, they will be having a sum assured of 10 crore, 20 crore sum assurance. Sum assured, term insurance and all they take. They take term insurance where the amount of premium payable is, more than 5 lakhs in a year. The premium payable for those policies is more than 5 lakhs. Every year they pay more than 5 lakhs premium. But still, the premium amount which they are paying, it is less than 10% of the sum assured. It is less than 15% of the sum assured. And these people, anyhow, they don't have any Chapter 6 and all, and are buying bulk, big insurance policies, and they are enjoying, they are getting maturity amount, which is also very huge amount, because they buy insurance policies where the high rate of where the return is very high. Getting it? Of course, it's not ULIP, normal insurance policy, aggressive policies they buy. So where the maturity amount is so big, income tax department want to tax those maturity amounts, especially to these high net worth, high paid individuals. Getting it? Department want to tax them. See, we gave exemption because what? All these exemptions were given for what logic? What is the reason behind it? Because, normal middle class or lower middle class or upper middle class, whatever it is, who are working as a salaried employee, if at all they are saving some amount, one of the savings method in India is insurance is one of the savings approach. So if they're saving money and they're getting maturity amount, if at all it is not a commercial policy, commercial policy means what? Where the premium is high every year. Non-commercial policy means what? Premium is not even 10%. Sum assured is 100. You are paying just less than 10, 5 or 6% or something, or less than 15. These are non-commercial policies. For them, income tax department gave exemption. But for commercial policies, even though even though premium payable in a year is not exceeding 10, not exceeding 50, but the sum assured is 5 crore, sum assured is 10 crore, sum assured is 1 crore, term insurance and all, where the SSC is paying premium, in percentage point of view, it is very less than 10%, less than 15. But if you look at the amount of premium which they are paying, the amount which they are paying is more than 5 lakhs for a single policy, for a single insurance policy, which the SSC is taking on or after 1st April 2023. Remember, this 5 lakhs amendment and all will be applicable only if the policy issued is on or after 1st April 2023. Suppose, if at all the policy is taken before 1st April 2023, and the premium that I am paying every year is some 10 lakhs for the single policy, still, is that insurance policy maturity taxable or exempted? What criteria we check? We only check these criteria. We only check what? 10%, 15%, 10% criteria. We don't check all this. From 1st April 2023, prospectively, if at all you are taking any insurance policy, the premium payable is not exceeding 10% of the sum assured or not exceeding 15% of the sum assured, as the case may be, is exempted, provided if at all the aggregate premium in any previous year for a single insurance policy, for a single life insurance policy, premium paid in any particular previous year is exceeding 5 lakh during the term of the policy. Suppose the term of the policy is 10 years. Any previous year, if at all aggregate premium paid in a particular previous year is exceeding 5 lakh, no exemption. That's a commercial policy. We will not give exemption. Income tax department straight away denied exemption. So indirectly, what are they saying? With effect from 1st April 2023, if I have to get exemption, if I have to get an exemption for a life insurance policy maturity amount, annual premium shall not exceed how much? First, it should not exceed 10% of the sum assured. In case of a person with disease or disability, 15% of the sum assured. Plus, for that policy, total premium amount in a particular year throughout the tenure of the policy, throughout the term of the policy, shall not exceed 5 lakh. If at all, throughout the term of the policy, suppose 10 years you paid premium every year. Any 1 year, if at all premium exceeds 5 lakhs. Sir, though I paid, let us assume 7 lakhs in 1 year, sir, but it is still less than 10% of sum assured. Still it is less than 15% only. Doesn't matter. The moment premium paid for a single insurance policy crosses 5 lakh in any previous year, straight away it loses exemption under 1010D. Straight away it loses exemption. No exemption. Straight away the maturity amount is taxable as per 56 subsection 2 clause 13. You see, I am not saying maturity amount is fully taxable under 56.2. I am saying maturity amount is taxable as per the section. In the section, they tell you how to tax it. Maturity amount. First time, what I am saying right now here, maturity amount is taxable. That's what I am saying. I am not saying how much is taxable. So, no exemption. Fine. Very good, right? This amendment is very good. But our SSCs are very clever. If at all for a single insurance policy, if the premium amount is exceeding 5 lakh, okay, you will tax it. What SSCs will do, if at all this kind of provision, if at all this kind of condition is added, people are very clever. They take multiple policies. What they do? They take multiple policies where each policy premium will not exceed 5 lakh. For each policy, premium will not exceed 5 lakh. So, because everybody got to know about this amendment, if I pay for a single policy more than 5 lakh, department will tax straight away that policy maturity amount. If I get maturity, that amount is fully taxable. So what SSCs cleverly can do? They will start taking multiple policies on or after 1st April 2023. Like I'll take 4 policies where every policy the premium is 1.5 lakh only. Every policy 1.5 lakh only premium. For a single policy premium will not exceed 5 lakh. So every policy premium is 1.5 lakh, less than 5 lakh for every policy. And for each policy, whatever premium I'm paying, it is less than 10% of the sum assured. Percentage wise less than 10, amount wise less than 5. Like that, I will take multiple policies and I will violate this intention of this section. No, that is also not possible. Department added another proviso. If at all, this is where the entire confusion for the students, this provision is what entirely confusing. To clarify this provision applicability only, they gave in the supplementary material 10 problems, 10 illustrations they gave, and that illustration students are struggling like anything to solve those illustrations. But you see how easily I'll make you to solve without even reading single line in that. Directly see the question and look at the answer, it will match. So in such a way I'll make you listen carefully. So understood, right? Second, this another provision. Now SSCs know what they do. They take multiple policies. After 1st April 2023 onwards, they'll be taking multiple policies. If at all policies are taken before 1st April 2023, 5 lakh limit and all, no need to bother. I have taken policy before 1st April 2023. It is less than 10% of the sum issued. Straight away exempt. Maturity amount is exempt. Starts it. No more taxability. The problem is, if the policy is taken by you on or after 1st April 2023, less than 10%, less than 15%, no doubt we will see. In addition to that, one more condition we will see. For a single policy, if the premium paid is more than 5 lakh, no exemption for that. What about if I take multiple policies? What about if I take multiple policies where in each policy, premium is not exceeding 5 lakh? In that case, what will you do? If at all, aggregate premium for all those policies, aggregate premium for all those multiple policies taken on or after 2023, the aggregate premium for all the policies which are taken on or after 1/4/2023, if the aggregate premium exceeds 5 lakh, if the aggregate premium is exceeding 5 lakh in any previous year during the term of those policies, suppose I have taken 4 policies, 1.5 lakh, 1.5 lakh, 1.5 lakh, 1.5 lakh, 4 policies I have taken. Aggregate premium of these 4 policies how much? 6 lakh. Now the 6 lakhs in any 1 year during all these terms, in entire the terms of these policies, all these policies are valid for 10 years. Getting it? In all the 10 years, all these 4 policies put together more than 5 lakh. Or maybe 10th year only all the 4 policies put together cross 5 lakh. Up to 10th year, each policy is 1 lakh, 1.2 lakh only. Up to 9th year, less than 5 lakh total amount. But 10th year, premium is increased. In the 10th year, all 4 policies put together, premium total, how much I paid, more than 5 lakhs I paid, 6 lakhs I paid. In any previous year, aggregate premium for such policies is exceeding 5 lakhs in any previous year during the term, then exemption is available only for those policies whose aggregate premium in any previous year does not exceed 5 lakh during the term of their policy. This is something similar to single insurance policy. If at all you have taken a single insurance policy, if the premium payable does not exceed 5, I'm giving exemption. Here you have taken multiple policies combined together. What is the total premium paid? Not exceeding 5 lakh. Then you will get exemption. What does it mean? You see here, suppose, if this example itself I will take, you see here, what happened? I have taken 4 insurance policies. Each insurance policy is less than 5 lakh. But aggregate of this is more than 5 lakh. Now you see, aggregate premium for all the policies which are taken on or after 1st April 2023 is exceeding 5 lakhs in our example. Yes, it is exceeding, sir. In one of the year it is exceeding, sir. 10th year it is exceeding, sir. Okay. So which means this provision of first party satisfied. Now exemption is available. Yes, available. Only for those policies whose aggregate premium in any previous year. Only for those policies whose aggregate premium does not exceed 5 lakh. 3 policies if I total together, 3 policies put together I'll total. What is that? Out of 4, I will claim the exemption for 3. What is the premium paid for these 3 policies? 4.5 lakh only. So only those policies whose aggregate premium does not exceed 5 lakhs in any year. 3 policies I've selected. These 3 you can claim exemption. Now the one policy which do not come under exemption, this is tax. Sir, can I claim exemption for all the 4? Aggregate premium for all these 4 policies exceeding 5 lakh, man. Getting it? Since it is exceeding 5 lakh only, we are giving exemption for remaining policies. Whether you will take these 3 policies, exemption. Whether you take these 3 policies, whether you take only for 2 policies, that is your choice. But you have 4 policies totally, right? All the 4 put together, premium is crossed 5 lakh. You cannot claim exemption for all the 4. But you can claim exemption for either 3 or 2, provided The premium for those two policies, premium paid for those three policies in any previous year shall not exceed 5 lakh. In such a case, you can claim exemption. I hope you're clear by 90%. Still 10% confusion. That's why I say I've given CBDT. That's why CBDT has given a clarification with so many examples. Shall we solve those examples? I think you'll understand better. Yes. Let's try to go to the supplementary material and solve the examples. No need to read this entire theory. You are done. You know, here they say situation 1, situation 2, that and all not required. You straight away look at this problem. Now, straight away, entire provision. On the entire provision, I'm applying. Okay. Just a minute. Yes. Let's look at this example. Straight away, we'll solve examples and apply the as it is provision, whatever we discussed in the past 20 minutes. Okay, fine. So what is the date of issue? 1st April 2013, not after 2023. Therefore, 5 lakhs criteria and all do not apply. So what criteria we should apply? Since after 1st April 2013, disabled guy and a person having disease 15%, others 10%. Here, no, they have not given any information. So life insurance policy A. So let us take an assumption that all the examples are from the point of view of a normal guy, a normal human being who is not having any disability, who is not having any disease under 80 DDB. So that's it. So 1/4/2013 means after 2012, right? Now what is the sum assured? 60 lakhs. How much amount of annual premium which he paid? 6 lakhs only. Now what is the percentage? 10%. 10 clause 10D, can I claim exemption? Yes, absolutely, because the premium paid is not exceeding 10, right? It is exactly 10. If it crosses 10 only, the problem. If the annual premium payable for an insurance policy does not exceed 10%, means up to 10 is permitted, it is exempted. Now how much amount is received? 70 lakh. So entire 70 lakh is exempted. Over. The answer is over. The consideration received under LIC A, so life insurance policy A, would be exempt since the annual premium does not exceed 10% of the sum assured. Moreover, the policy is issued before 1st April 2023. You see here the premium paid is 6 lakhs, but it doesn't matter because the policy is issued before 1st April 2023. When amount of premium we will see mainly, whether it is a single policy or multiple policy or whatever it is, when the amount point we will see only when the policy is issued on or after 1st April 2023. Amount will come into picture. For exemption purpose, we only say percentage always. Amount we will see only if the policy issue date is on or after 1st April 2023. Correct? So, since the policy issued before 1/4/2023, limit of 5 lakhs is not applicable. Therefore, since it is not an eligible ULIP, of course, it is not ULIP also. By the way, this is not a ULIP. They have given very specifically that it's an LIC. So, note this note point is also not required. This note point is not at all required. Ignore it. Next, example number 2. This note point is required for the later thing. Okay. For now, it is not required. Another example. 1st April 2023 policy is issued. The moment you see 1st April 2023, immediately what it should strike? Amount also you should check. For calculating exemption, for determining exemption, amount of premium paid annually also you should check. What is the annual premium paid? 5 lakhs only. If it is more than 5 only, the problem comes. What is the sum assured? 50. What is the percentage? 10%. The policy is taken on or after 1st April 2012 means 10%. Moreover, the policy is taken on or after 1st April 2023, which means 5 lakh. If at all premium paid exceeds 5 lakh, obviously it is taxable. So it is less than 10, less than or equal to 10% of the sum assured, and amount is also not exceeding 5 lakh. Therefore, amount consideration whatever you are receiving 52 lakh fully exempt. So the consideration received would be exempt under 1010D. When it is received, by the way, 1st November 2033, which means previous year 33-34, which means assessment year 34-35. So for the assessment year, entire amount received is exempted since the premium payable on the policy does not exceed 5 lakh and moreover it does not exceed 10% of sum assured. Next, another example, example 3, policy name is A. Now, when the policy is issued 1st April 2023, immediately we should check 10% criteria, plus we should also check 5 lakhs criteria. How much is the premium paid? 6 lakhs. So what is the sum issued? 60 lakh. Premium paid is less than or equal to 10% only. But the policy is issued on or after 1st April 2023. And moreover, you see this is a single insurance policy. Only one policy data they have given. Yes or no? For a single insurance policy, the premium paid is exceeding how much? 5 lakh. Therefore, entire 70 lakhs is not exempt under 10 clause 10D. It is not exempt under 10D. The consideration received is not exempt under 10D because the annual premium payable is exceeding 5 lakh. So simple until now. I hope you are able to correlate. Now let's look at this. Let's look at this. This situation here, they have given no circumstance, eligibility for exemption, that and all. You don't read, ma. If you read that, you will never understand anything. Look at the diagram. What I, just follow the diagram which I explained. Not even diagram. Look at the content which I'm explaining and then sync it with the given example. Now you see life insurance policy number A policy. Are two policies were there? Okay. When these two policies were issued, date of issue 1st April 2023, 1st April. Both are issued on or after 1st April 2023, which means we should see percentage first. Then we should also see what? Aggregate premium for both of them put together, we should check. Now let's see. Annual premium paid is how much? Here it is 3 lakhs, sum assured 30. So first criteria for exemption, amount paid to sum assured, it is 10%. Here also amount paid to sum assured, it is 10%. Both the policies are less than 10% of less than or equal to 10%. So one of the criteria for exemption, both the policies satisfied. Suppose no, if at all for policy B, if the premium is 2.2 lakh, if the premium is 2.2 lakh, which is more than 10%, B is straight away taxable. No need to talk about exemption. But B policy, insurance policy B less than 10%, insurance policy A less than 10%. Both are less than 10%. One of the criteria for exemption they satisfied. But one more criteria is there. Because both the policies are issued on or after 1st April 2023, we should see what is the aggregate premium paid for both the policies. Annual premium, how much they paid? 3 lakhs for A, 2. Both the policies put together, how much premium paid? 5 lakh only. Aggregate premium paid for multiple insurance policies is not exceeding 5 lakh. Not exceeding 5 lakh. There, and moreover, for both the policies, the amount of premium paid for each policy is less than or equal to 10% of sum assured. And aggregate of both the policies put together 5 lakh. Exempted. Both are exempted. Correctly? So how, now what is the maturity you receive? 32 lakh, 21 lakh. Both are exempted. In this case, aggregate premium payable does not exceed 5 lakh during the term. And for moreover, annual premium, both of them are not exceeding 10% of sum assured. Therefore, the consideration received would be what? Exempt under 1010D. Easy or not? Fine. Let's see another example. By the time we solve all the 10 examples, you will be master in this provision, believe me. Next, let's see another example. What is the date of issue? 1st April 2023, which means we need to see 10% criteria as well as we should see 5 lakhs criteria, both. Fine. First, let us see 10%. What is the premium you are paying? 4.5. Sum assured is 45 lakh, 10%. Here also you are paying 5.5 lakh premium, 55 lakh sum assured, 10%. Both, first criteria for exemption, both the policies satisfied. But you are having two policies, not single policy. In such a case, how exemption is to be calculated? If for multiple policies, if aggregate premium payable, no need to even see to that extent. For one single policy itself, straight away, aggregate also no need to check here. Because one policy is straight away paid annual premium, how much? More than 5 lakh. Straight away, this entire 60 lakh is not exempt. You need not even check aggregate amount. If at all no, B policy, this is also less than 5 lakh. Then A and B put together, you should check. Already B, only one policy is straight away crossed 5 lakhs. Na? Therefore, you need not see aggregate picture also. Single policy itself crossed 5 lakhs. What is the question? Straight away it is not exempt. What about the remaining policy? Other policies, no. Only one policy is there where the aggregate premium in a year does not exceed 5 lakh. And moreover, percentage also not exceeding 10%. This 52 lakhs is exempt. This 52 lakh is exempt under 10 clause 10D. I hope now by this time you might have got 95% clarity, not 100%. You have not got 100%. Wait, remaining illustrations once you solve, you will get 100% clarity on this. Okay, that's it. It is exempted. I hope you understood now. Let's look at the answer. So consequently, consideration received under B would not be exempt, which means the consideration received under A is exempted. Aggregate premium for both are exceeding 5 lakhs. In that case, what is the provision if at all SS is having multiple policies? If at all multiple policies put together is exceeding 5 lakh aggregate, only those policies whose aggregate premium does not exceed 5, that is exempted. However, the consideration for A would be exempt because annual premium payable is not exceeding 5 for any previous year. And moreover, it does not exceed 10%. But B policy is taxable because It is the single policy itself is more than 5. So that itself is enough. Now let's look at another example. Example number 6. Then the policy has been taken 1st April 2023, 1st April, 1st April. Oh, all the three are taken on or after 1st April. 3 policies SSC is having. Now, what is the annual premium paid? 1 lakh, which is 10%. Of course, this is also 10%. Of course, this is also 10%. But you see, insurance policy C, na, the amount of premium paid is already crossing 5 lakh. Already crossing 5 lakh. So only for single policy C itself, it is crossing 5 lakhs. Forget about remaining multiple. That one policy itself is crossing already 5. This is straight away taxable. This is straight away taxable. Now remaining two policies put together, 4.5 lakh. Remaining two policies put together 4. Since the remaining premium is not exceeding 5 lakh, remaining policies premium is not exceeding 5 lakh, these two policies I will claim exemption. They are exempt under 10 clause 10D. 10 clause 10D. Are you getting it? Now I applied the provision in such a way. C policy I separately did. For A and B alone I applied the provision. I got the right answer, but this is not the way to do the answer. You need to apply 7th provision carefully. If multiple SSC, if at all is having multiple policies, aggregate premium under all these policies are exceeding 5, then exemption is available only for those policies whose aggregate premium does not exceed 5 lakh. Now, okay, for 3 policies put together, premium is crossing 5 lakh. Now, exemption is only for those policies whose aggregate. Now, can I claim exemption for A and C? No. If A and C total, more than 5. Can I claim exemption for B and C? No. For B and C put together, it's more than 5. Can I claim exemption for A and B put together? Yes. For A and B put together, total premium is still 4.5 lakh, not exceeding 5. So, I will claim exemption. You should apply the provision exactly. Here, no. Even if I do not apply provision straight away. For C, no. Straight away premium is more than 5. So, it is taxable. For remaining two, both put together, since premium is less than 5 lakh, both are exempted. So easy. But this logic may not always correct. This logic we apply may not always correct in all the circumstances. Fine. I will show you the next problem. So by the way, so consideration received under C alone would not be exempt. C alone is not exempt, which means A and B is LIC A and B would be exempted. Since aggregate premium for these two policies do not exceed 5 lakh. Okay, 3 insurance policies understood. Look at another example. From here, be careful. Yes. Just observe what I am reading and explaining. Until I say, yes, example number 7 is finished, don't come into any conclusion. So, until I say example 7 is over and going to example 8, until that, don't conclude anything about whatever I'm talking. Listen until I move to example 8. Entire example 7 you listen and then take your conclusion. Fine. What is it? When the policy is issued? 1st April 2022. If it is issued on 1st April 2022, I will see what is the percentage. 5 lakh 50, 55 lakh. Percentage is how much? 10%. It is less than or equal to 10%. Right away the amount is what? Exempted under 1010D. Sir, annual premium is more than 5. It doesn't matter, man, because the policy is issued on 1st April 2022. Before 2023, the policy is issued. So straight away exempt. Good. What about remaining 3 policies? Remaining 3 policies were issued on or after 1st April 2023. What is the annual premium that they are paying? First 10%, and this is also 10%. Of course, this is also 10%. In all the 3 policies, the annual premium paid is not more than 10% of the sum assured. But you see, for insurance policy C, no, the premium alone, single premium alone is single amount. The annual premium is more than 5 lakh. Straight away, 1010D will not apply. I will say this entire 70 lakhs is not exempt. This entire 70 lakhs is not exempt. You see, I am not looking which year it is. I am ignoring this. That's not relevant for me right now. I will discuss about this year point later. This is not exempt for me. Okay. So if the SSC has taken on or after 1st April 2023 multiple policies and all multiple policies premium annually is more than 5 lakh, then only those policies A and B whose aggregate premium does not exceed 5 lakh, will be exempt. A and B aggregate premium is 4.5 lakh throughout the term of the policy from 2023 to 2033. Up to this, every year premium paid is not exceeding 5. So for both of them, I will claim exemption. So it is exempt. It is exempt. Now immediately, if at all you are not getting this doubt, very good. If at all you are getting this, sir, what about this premium 1.4? This will not at all considered in aggregate premium 5 lakhs. That criteria, no, we don't consider this itself because the policy is taken before 2022, which means in this example, this is exempted, X is exempted, A is exempted, B is exempted, only C got taxed. So you see here, the conclusion is, consequently, the consideration received under LIC, life insurance policy C alone would not be exempt under 1010D. Which means in respect of A, consideration received under A and B would be exempt, and moreover LIC X policy is also would be exempted. X policies also would be exempted. As per CBDT guideline, no. Only if a policy is taken on or after 1st April 2023, that comes under eligible policy for 5 lakhs criteria. So X policy is not an eligible policy, eligible LIP. What is this eligible LIP? Eligible LIP means what? Eligible LIP means those policies which are taken on or after 1st April 2023. If at all an insurance policy is taken before 1st April 2023, that is not an eligible policy for 5 lakhs criteria determination. Therefore, LIC policy X is not an eligible policy because it is taken before 1st April 2020, before 1st April 2023. Therefore, limit of 5 lakhs is not applicable. What clarity? Now you see. Here if you observe, X related insurance maturity amount is received in 32-33 previous year 32-33, nothing but assessment year 33-34. In that year they claimed already exemption. And moreover, 3 insurance maturity amounts we are getting, A, B, C in previous year 33-34, nothing but assessment year 34-35. Now out of 3, A is exempt, B is exempt, C is taxable. C is taxable under which section? 56 subsection 2 clause 13, it is taxable. How much is taxable? That amount, no, the CBDT has given a formula for that, how much is taxable. As per that we will have to compute. No, so that formula we will discuss later after we finish 2 or 3 more examples were there. After we finish that, we'll discuss that. I hope until now you understood example 7. Now it is over. Example number 8. This theory is irrelevant. Don't read at all. You will not understand anything if you read that. Look at the direct question. Same analysis, whatever analysis I'm applying, no, same analysis you apply. Don't even change the analysis. Now, example number 8. Little more critical. Be careful. Observe carefully, because what I have seen in many students is from example 8 onwards only they are unable to understand. Especially example 9 and 10, many could not understand. I will tell you very simple. The problem is they are looking at the years. Ignore the year for the time being right now. Okay. We will understand the year logic later. Now look at example number 8. How many policies is having? 4 policies. X, A, B, C. When the policies were issued, all are eligible LICs only, because all are issued on or after 1st April 2023, which means 10% criteria we should check, 5 lakhs criteria we should check. Moreover, multiple policies, provision 7 we should check. Getting it? What is the percentage? 10. Here also 10. Here also 10. Here also 10 only. Everywhere it is 10 only. But routine learning, straight away policy number C. Since the annual premium is more than 6 lakhs, more than 5 lakhs, straight away, this is not exempt. This is not exempt. I will apply that in the not exempt. This entire 70 lakhs is not exempt. This is taxable. Straight away will tax it. But remember, the C related maturity amount is received when? 1st April 2034. Previous year 34-35 year. Assessment year 35-36. ABC, all these 3 are received in assessment year, previous year 34-35. Fine. Forget about the year right now. Next. Now look at XAB. Okay. X policy, the consideration X amount is matured in 33-34, assessment year 34-35. Whereas A and B is matured in 34-35, 35-36 assessment year. Forget about the year right now. Now look at it. Now, C policy we understood. Now you see, aggregate premium for more than, because all these are multiple policies, right? Multiple policies, right? Aggregate premium is exceeding 5 lakhs. Yes. In such a case, exemption is available for only which policies? Exemption is available only for those policies whose aggregate premium do not exceed 5 lakh. Whose aggregate premium do not exceed 5 lakh. Now here XAB is there. Aggregate premium is how much your aggregate premium? These three put together na 4.5, 1, 1.5, 7 lakhs it is coming. So I cannot claim exemption. So can I claim exemption? So these three put together is more than 5 lakhs, no doubt. So either I can claim exemption for A and B, because A and B both put together less than 5 lakhs. Can I claim exemption for X and A? No. Can I claim exemption for X and B? Both put together aggregate premium is more than 5. Can I claim exemption for X and A? More than 5 lakh. Can I claim exemption for A and B? Yes, both put together less than 5 lakh. You getting it? Remaining policies, see, if C straight away is taxable, because single premium policy itself more than 5 lakh. For a single premium policy already more than 5 lakhs is straight away taxable. What about remaining policies? Where annual premium of each policy is less than 5 lakh, where annual premium of each policy is less than 5, but aggregate is more than 5. If a single policy is more than 5, straight away taxable. Now I want you to revisit the definition. For a single insurance policy, if the premium is more than 5 lakh, straight away no exemption. If at all, multiple policies SC took, single policy, it's multiple policies, each policy is less than 5 lakh. But aggregate premium for each of the aggregate premium for all these policies are exceeding 5 lakh. For a single policy, if at all straight away premium is more than 5, straight away taxable. For multiple policies, where each policy, premium every year is less than 5, but total is more than 5. Now apply this logic. For remaining policies, each policy premium is less than 5, but aggregate is more than 5. Then exemption is available only for those policies whose total premium is less than 5. Now, okay, so XAB aggregate all three put together more than 5. Then can I claim exemption for only those policies? Either of any two policies I can claim exemption, provided these two policies premium paid put together do not exceed 5. So X and A I want to claim, both put together is crossing 5, so I can't claim exemption. X and B I want to claim, both put together it is exceeding 5 lakhs, so I can't claim exemption. A and B I want to claim, both put together is not exceeding 5 lakhs, so I can claim exemption. So therefore, this is exempted. This is exempt. This is exempt. Whereas this is not exempt. This is not exempt. This is not exempt. Now here logic we should check once. First of all, if you observe, X policy is received in 33, 34. In this example, this is first year in which the maturity is received. In these four policies, first maturity amount happened where for 33, 34. In the subsequent year, remaining policies were mature. Now suppose, if SSE, here SSE has to do a tax planning. Carefully, SSE has to do a tax planning. This is exempt, right? Now, based on this, we understood like this. Now let us see how much maturity amount received. We should be very clever. 50 lakhs is a maturity amount which you are saying not exempt. For these two policies put together, since the premium is less than 5 lakh, you are saying exempt. Both put together, how much amount is there? 30 lakh only is their maturity amount. Whereas for this policy, 50 lakh is their maturity amount. Now, I said, right, two policies put together, since premium is less than 5 lakhs, it is exempt. That's what I told, right? But I will not claim exemption for this. I will not claim exemption for this. No, I will not claim. I will claim exemption only for X, because for X alone, what about A and B? Two policies. Okay, let them tax, because both the policies, if taxed also, total taxable amount is 30 lakhs only. But for X policy, maturity amount is 50 lakhs. So big amount. So what I will do, I will claim exemption for X. That's why you say I wrote blue color. Now I am writing my final answer. I will claim exemption for X policy, whereas I will tax A policy. Red color I'll write. I will tax policy number A. I will tax policy number B. Why? Because for policy number A, policy number B put together, total amount of maturity is 30. Maximum worst case, how much is taxable? 30 lakhs only. But if I claim exemption for these two, you know what is the provision says? What the provision says? If at all, aggregate premium payable for multiple insurance policies where each policy premium is less than 5, but aggregate is more than 5, SSC can claim exemption for any policies of his option at the option of the SSC. Aggregate premium if it is not exceeding 5, that's SSC's choice. Whatever policies you want to claim exemption, ensure that aggregate premium for those policies not exceed 5. Now what I did originally, we did these two comparison, but we did not immediately. Some students may not observe, array maturity amount also you should see. Maturity amount also you should see. It's not how many policies you are claiming exemption, it's for how much maturity amount you are claiming exemption. That is important. From tax point of view, amount is important rather than the number. Getting the point? Since maturity amount in X is 50, whereas A and B put together only 30. Tell me, if I have given an option, will you claim exemption for 50 lakhs or will you claim exemption for multiple items put together 30 lakhs? Are 50 I will claim exemption, man. Why 30? So single policy alone I will claim exemption. Remaining two I will offer for taxation. What clarity? Now here there is one more logic. Suppose if at all SSC did not claim exemption for this. If SSC did not claim exemption for this, thinking next year A and B maturity will come, now that year maturity amount will be high, so I will claim exemption for that. SSC will lose. SSC will lose. Getting it? In that case, even updated return also we cannot file, because updated return we can file only when there is an increase in income, not decrease in income. Getting it? So we have to be very careful. So the moment when X received this amount, you should immediately inquire with the insurance company. Dear insurance company, next year my A and B are also maturing, right? How much amount I will be getting approximately? Ask them. Suppose if the insurance company says, sir, put together 60 lakhs you will get, sir, then don't claim this exemption. You offer for taxation. A and B are receiving next year, right? Both put together 60 maturity amount, right? Claim exemption for that. You need to apply tax planning. That's why they have given years here to confuse you. So here, consequently, A, B, C would not be exempt. Straight away, we will claim exemption for X, as it does not exceed 10% of the sum assured. Clear? Not yet over. The game is still there. We have two more examples. If at all you understood example number 8, 9 and 10 will be damn easy for you. Okay, just a minute. Yes. So example number 9. In all these cases, if you see, the policy is issued on or after 1st April 2023. First of all, is there any single policy where the premium paid is exceeding 5 lakh? Yes, C policy is there. Premium paid is straight away more than 5. I will tax it, not exempt. So straight away I will tax it. What about remaining policies? Premium paid for each of them is less than 5, but aggregate premium is more than 5. Then exemption is available at the option of the SSC for those policies where aggregate premium do not exceed 5. X and A, aggregate premium is 4.5, not exceeding 5. X and B, aggregate premium is 5 only, not more than 5. So I can claim either exemption for X and A or X and B. I can claim. But let us see. Let us not decide based upon this. Let us see based upon maturity amount. How much maturity amount you are having? 38 lakh. X policy 30 lakh. A policy 24. I can claim exemption either for X and A or X and B or A and B. Anyway, I can claim exemption, right? Now, I will claim exemption for which two policies? Those two policies maturity amount which is high. Now, X and A put together maturity amount is how much? 30 lakhs and A 24, 54. X and B maturity policy is how much? 30 plus 38, 68. A and B maturity amount is how much? 24 plus 38, 50, 62. So, any two combinations I can claim. I can claim either X and A, or I can claim X and B, or I can claim A and B. Now, either this I can claim, this I can claim, this I can claim exemption. But which one I will claim exemption? I will claim exemption for X and B policies, because X and B put together, the maturity amount is more than, this maturity amount is highest of any other two combinations. Therefore, I will claim exemption for X and B. So, I will claim exemption for X and B exempt. So, I will tax it. I will tax A policy, insurance policy number A. Now here you need to exercise this again. But you see, X policy is matured in 1 year, 33, 34. Remaining policies are matured in 34, 35. So here only the problem comes. So what X has to do, can he claim exemption for, this policy in this year, in the year in which he got this maturity amount? He should inquire, dear insurance company, how much I will get for A, how much I will get for B in the next year. Generally, if the policy is maturing in the next year, most of the times maturity amount is very, very predictable. Very rare cases only it is not predictable. Ask insurance company, how much I am going to get. Suppose they told you, sir, you are going to get this much, sir, for A and B. Then you can happily claim X policy exemption. Suppose no, insurance company said, sir, for A no, for A policy no, sir, you are going to get 40 lakhs, sir, not 24, you are going to get 40, they said. Then I will do one thing. I will not claim exemption in this year. No, I will tax it. A and B next year put together, 40 plus 38, 78, I will claim exemption in the next year. You getting the point? But in this example, whatever the point I told right now, that's why year is given to confuse you like this. Year is given to confuse you like this. Getting it? Generally, what happens, we don't think about the next year. So if you have multiple policies, you should do a proper tax planning. You should think about the next year maturities, how much I'll be getting. Because in a lifetime, if at all you're having multiple policies, maximum premium for not more than 5 lakhs, aggregate premium of all the policies in your lifetime, up to 5 lakhs, getting it? Only that you can claim exemption. Able to understand? 2 policies. Now you see eligibility for exemption. In this case, so what are the 2 policies I am exempting? A, X and B. A and C I am taxing it. Look at the conclusion, alternate answer. The most beneficial treatment is claim LIP X, claim LIP, life insurance policy B as exempted. This is the best answer. This is the best answer. So original answer, no, they have given so much of explanation. What they said is very simple. Since LIP X is exempted because it is not exceeding 5 lakhs, so it is exempted. They claim X exemption. Aggregate amount of premium for A and B and C along with the LIC X exceeds 5 lakhs during the term of these policies. However, consideration received for A and B can be claimed as exempt under 1010D. So you can claim exemption for 1010D for A and B. If consideration received under LIPI is claimed to be exempt as aggregate of the annual premium payable did not exceed 5 in any previous year, the consideration under B would not be exempt. Same entire that analysis, whatever analysis we did, they are just explaining it. If consideration received under policy B is claimed to be exempt as aggregate of the annual premium payable for X and B did not exceed 5 lakh. Hey man, nothing but whatever analysis I told, no, that only they're explaining. You can write this analysis in your own words. It's a taxation subject, not an audit subject. You can write happily in your own words. Whatever analysis I told, no, that you write. If you read this and all, no, your mind will be corrupted unnecessarily. Whatever analysis we did, they are explaining it. The best answer that we already, if at all, X was not claimed exempt under 1010D, the consideration received under LIPA would be exempt in 35 since aggregate premium payable for A and B did not exceed 5 for any previous year. However, the most beneficial treatment is X and B you claim exemption, not A and B. Getting it? So that's why year and all don't see at first. Year don't see in exam at first. Don't see year. Maturity amount, in one of the problem they said maturity amount is received in so and so year. Look at another maturity amount is there. Some more maturity amount see. If at all there. Ignore here and see this criteria and claim exemption for those 2 policies and give that explanation in the notes to accounts in the problem. Getting it? Don't worry. Question number 10 is even more bigger. 5 policies were there. Until here at least we have only 4 policies, but here we have 5 policies. You see, I think now you will get, I think right now, I think you're having already 99.9% clarity. With this, you will get that even 0.01% clarity also. Policy issued is on or after 1st April 2023. All are eligible policies where you need to check 10% criteria plus 5 lakhs criteria. Is there any policy, single policy where premium is more than 5 lakh? Yes, straight away as per provision 6, taxable. It is not exempt, straight away taxable. Is there any other policy where the premium is less than 5? Yes. But aggregate is more than 5? Yes. Provision 7 you need to apply. For all these 4 put together, provision 7 you need to apply. And if you observe, one policy is received in year 1. This is year 1. Another policy is received in year 2, 34, 35. Another policies, remaining policies are received in year 3, 35, 36. 3 years. The maturity amounts are received in 3 years. In 3rd year, 3 maturities were received. Of course, 3rd one straight away we tax it. A single insurance policy premium is more than 5 lakhs. Straight away we tax it. Now, so remaining policies, let us see. Remaining policies, no? Aggregate premium is more than 5 lakh, right? Where insurance premium payable for a single policy is not exceeding 5, but aggregate of premium for all multiple policies are exceeding 5 lakh at the option of the SSE. At the option of the SSE, he can claim exemption for all those policies whose aggregate premium does not exceed 5 lakh. Now, X, Y, A, B, all four put together, premium is exceeding 5. SSE can claim exemption for what and all? SSE can claim exemption for X and Y. SSE can claim exemption for Y and A. SSE can claim exemption for A and B. Can SSE claim exemption for X, Y, A put together? Again, it is crossing 5 lakhs. Can the SSE claim exemption for YAB? Again, it is crossing 5 lakhs. So, either you can claim X and Y, or you can claim Y and A, or you can claim A and B, or you can claim X and A put together 4 lakhs only, or you can claim X and B put together 5 lakhs only, or you can claim Y and A put together 4 lakhs only, or you can claim Y and B put together 5 lakhs only. So many combinations. So now, which one I will claim exemption depends upon the maturity amount. Now look at this. I will put this on the this one. I'll put it on the paper. Be careful. Don't make yourself hurry. Don't hurry up. X policy how much? 12 lakhs. Y policy how much? Y policy is 24 lakh. 24 lakh. A policy is how much? 24, 36. B is 36. A is 24 lakh. B is 36 lakh. Now, by the way, annual premium is how much? 2223. That's it. 2223. Now, aggregate of all these policies is more than 5. So, you can claim exemption for any those policies whose premium is less than 5. But here 3 means again it's more than 5. So, any 2. So, either these two I can claim, or these two I can claim, or these two I can claim, or these two I can claim. Correct? Or these two I can claim, or these two I can claim. These two I can claim anyway. Now, let us see. Suppose if I claim exemption for X and Y, where both put together annual premium is how much? Where annual premium X and Y 4 lakh. What is the maturity amount? Maturity amount is how much? 12 plus 24. How much is the maturity amount? 12 plus 24? 36 lakh. Now, okay. Now, then X and A. Getting it? Both put together 4 lakhs only. Premium paid is not exceeding 5. What is the maturity amount? XA. So XA, X 12 plus 24. Oh, here also the same. 36 lakh. Fine. Then X and B I will see. Both put together maturity is how much? X and B? Oh, 5 lakh. You see here. X and B 5 lakh. What is the X and B put together? 48 lakh maturity amount. Then fine. Now let us see. XY we saw. XA we saw. AB also we will see. A and B we will see. A and B put together how much it is? 5 lakh. Annual premium paid is 5. Both put together how much it is exemption? How much is the maturity? 60. Very good. Then Y and A we will see. Y and A how much? Both put together 4 lakhs. Y and A is put together 4 lakhs. YA combination has not come right. YA 4 lakhs. Y plus A 4. Both put together 48 lakhs is a maturity. Y and B we will see. Y and B both put together premium paid is 5 lakh. And Y and B put together premium is 60 lakh. Okay. Is there Y and X already? XY or YX both are same only. So 6 combinations I can claim exemption. I can claim exemption for either X and Y policy, or I can claim exemption under XA policy, or I can claim exemption for XB or AB or YA or YB. Now if you see, and if you observe, no, X policy is matured in year 1. Y policy is matured in year 2. A and B policy is matured in year 3. These amounts were matured not in a single year. If at all these 3 are matured in a single year, I can happily compare like this and claim exemption. But they were matured in 3 different years. Here the problem comes. But what I told, ignore the year. First identify best combination. What is the best combination you identify? You know what I will do? I will claim exemption for Y and B. But actually, there are so many other factors also come into play when you're doing tax plan. But let us not go that in depth. I will claim exemption for Y and B. Y and B, or why I will claim exemption? Why, why WHY I will claim exemption for policy number Y, because policy number Y is received in second year. Getting it? So first year, no, I will tax X policy. I will offer insurance company, sir, I will tax X policy, because no, I asked insurance company next year how much I'm going to get. Sir, you're going to get Y, 24 lakhs. That next year you're going to get A and B. So I do a pre-planning. Getting it? I'll call insurance company and ask, I know what's the maturity amount I'm going to get, all that. So accordingly, I will tax X. Getting it? And I will also tax A. I will claim exemption for Y. I will claim exemption for B. You can also claim exemption for A and B also, right? A and B also 60 lakhs, right? You can claim exemption for A and B also, right? No, I will not do that. Why? Second year I will claim exemption for Y policy. My tax level will be reduced. Third year, if you want A policy, I will tax it. Time value of money, interest at least I can save, na? Exactly. So Y and B, I will claim exemption. So I will claim exemption for policy number Y. I will claim exemption for policy number B. Getting it? You need to observe. That's why when you're seeing, when you see, now I applied time value of money technique also. Time value of money, financial management equation also I used. So when you're doing tax planning, you must think in all the angles. So which means, what are the policies are exempted? Y is exempted, and B is also exempt. So I will offer A, I will tax it A, and I will even tax X. X I will tax it because it is only 12 lakhs, man. Remaining a 2024, that and all big amounts. So X I will offer. If you want, first year I'll pay tax on the premium. I'll pay maturity amount, I'll pay tax on that. No problem at all, because the income itself is so low. So this is the answer. So finally the answer is what? Y and B are exempted. Look at the answer ultimately. So look at the answer ultimately. They have given so much discussion. The consideration is received under C is not exempt. That anyhow we know. C is not exempt. C we tax rate. We claimed exemption for Y and B, right? They have given entire this analysis. First year, second year, all that analysis they have given. The consideration received under A, B, C would not be exempt. Since aggregate of the premium, I told you A, B, C. C anyhow taxable. A, B also they are not claiming exemption. Better than this, what is better? If at all surrender value of X was not claimed to be exempt. Not exempt means what? If at all you tax it. In our example, what we did? In our example, we taxed A. Yes or no? We taxed X. We taxed X. If at all X policy is not claimed exemption, then the consideration received for Y would be exempt, and consideration received either under A or B, any one can be exempt. In other words, our answer Y or Y plus A or B. A or B, A 24 lakhs, B 36 lakhs. 36 lakhs claim exemption. Getting it? If the consideration received under A is claimed to be exempt as aggregate, premium payable for L and A, Y and A put together not exceeding 5. So the consideration B would not be exempt. But that is not a correct treatment. If the consideration received under B is exempt, aggregate premium payable for Y and B did not exceed 5. The consideration received for A would not be exempt. Exemption for consideration under B is preferred as it is most beneficial. So Y plus B is most beneficial treatment. That's what in our example also we solved. We solved the same. Getting it? A and B also you can claim exemption alternatively. But the point is, if at all I want to claim exemption for A and B, why I have to tax it? If I have to tax Y in the year number 2, I have to pay tax in much more in advance. Why to pay tax much more in advance? I will defer it up to year 3. Getting it? So I will claim exemption for I will offer A for taxation. Time value of money. If at all you understood, very good. So if at all on surrender of X, on maturity of Y, if at all you didn't claim exemption, then A and B would be exempt, which is not a beneficial treatment. Y and B is the most beneficial treatment. So you need not write entire this analysis in exam. This is just a CBDT clarification for purpose. In exam, you straight away write this answer. Y and B is exempt because aggregate premium is not exceeding 5 lakh. So now whether you claim exemption in year 1 or year 2 or year 3, you need to have a proper planning in the year 1 itself. Year 1 itself, you should get the entire data and do a tax planning clearly. So complicated. Now, by the way, clarification on GST component. Whether the premium payable or aggregate premium payable, for the policies issued on or after 1st April 2023, whatever the policies we are We are discussing on after 1st April 2023. Premium amount we are saying, right? Is that including GST component or excluding a CBDT clarified? Exclusive of GST, you check. Exclusive of GST, you check for the policies which are issued on or after 1st April 2023. And here also term insurance policy. Term insurance policy means if it is further clarified that the limit of 5 lakhs would not be applicable in case of term insurance policy where the sum is only paid to the nominee in case of death of a person. No amount is paid. Just for the sake of example, at the beginning of the class, I use a term insurance. But for term insurance policy, 5 lakhs limit and all will not apply. Why? Because in term insurance, maturity amount is generally received by nominees only. In term insurance, maturity amount will not be received by the policy holder. Any amount received on death of the policy holder, if any amount is received under death, it is always exempt. Getting it? Hence, any sum received under term insurance policy will be exempted under 1010 irrespective of the premium payable. Further, premium paid for such policies would not be counted for 5 lakhs limit. Why? Term insurance, by definition, term insurance means if the person who is insured is died, only then amount will come. Are you getting the point? In case of death, not just term, any policy, if at all maturity amount is received on death, it is exempted. 5 lakh limit and all we don't see. Key man insurance policy is always taxable. ULIP is taxable as per the ULIP related provisions. Provision number 5, provision number 4 and provision number 5 both are dealing with ULIP where 2.5 lakh limit and all is there. That and all is not there in CA Inter. In CA Inter, ULIP related taxation is not discussed. Next. Now, how to compute taxable portion? By the way, I hope you understood right now. I hope you understood right now entire 1010D thoroughly. So now, if you go back to this diagram and read once again, or even if you read in our amendments material once again. So what are exempted policy? Any sum received under insurance policy, including bonus, will not be included in total income. When if the policy is issued on or after 2012, but before 2013, where the premium payable for any year does not exceed 10%. Exemption is not available if the premium is exceeding 10. Exemption is available if the premium is not exceeding 10. If policy is issued on or after 1st April 2013, where it is issued for a ATU or a person having diseases, then the amount is exempted. However, exemption is not available if the premium payable is exceeding 15%. Indirectly, if the premium payable does not exceed 15, exempted. Where insurance is on other persons, 10% is the criteria. Suppose if the policy is taken on or after 1st April 2023, you must check whether it is 10% or 15% logic, you should check. In addition to that, if at all, for a single policy, if the premium payable is exceeding 5 lakhs, exemption is not available. Suppose you are having multiple policies where each policy is less than 5, but aggregate premium payable on such policies exceed 5 lakhs in any previous year during the term of the policy, exemption is available only for those policies at the option of assessees whose aggregate premium does not exceed 5 lakh. You see, straight away I applied this provision on the problems. I did not read the entire supplementary material, situation 1, situation 2, cases, multiple policies, single policy, the theory and all they gave. Don't even read that. If you read that, you will not understand. Straight away read the provision, understand the provision, apply the provision. And that's what I showed you in all the 10 problems. Next. Let's look at one more related amendment. Taxability. So when the amount received under insurance policy is taxable under 56 subsection 2 clause 13, if it is not exempt under 1010D, it is taxable. How much is taxable? For that also I have given a note. How much is taxable? Maturity amount from life insurance policy which is not covered under 1010D, only income portion is taxable under other sources. What is income portion? Taxable amount is how much? Maturity amount how much? Just now we saw 36 to 24 lakhs, all that maturity, that is maturity, minus. See, whatever premium I'm paying, no, that also they're returning it back, right? Whatever amount I paid, that they're returning back. Can I call it as income? No. But premium I paid, no, I claim deduction under income tax. When I paid this premium, no, I claim a deduction. Now I am getting it back. It is income. Suppose I paid premium so much, ATC and all, I have so many other principal, housing loan, principal repayment, so many items I claimed in ATC. Getting it, 1.5 lakh over limit. Insurance premium related, I did not claim single rupee under ATC. Whatever premium I paid, that also they are adding and then sending it me back. How can I tax whatever amount I paid? That also I'm getting in the maturity amount. That I will exclude. Aggregate premium paid and not claimed as deduction under provisions of the law. Whatever premium I paid in the past 5 years, 10 years, but I did not claim deduction, that I will eliminate from the maturity amount. Only balance I will tax. That's what the supplementary material, they gave a clarification, another clarification. For that, they used A, B, A minus B, C minus D, all that. This and all is not required. Getting it? First previous year, first time when you receive maturity is called first previous year, subsequent previous year, that and all not required. Very simple. Have you received any amount? Yes. Minus what is the aggregate premium paid during the term till the maturity date, which has not been claimed as deduction. Check out. For each policy, how much maturity you got, how much premium you paid, whether that premium you have claimed deduction. If so, don't reduce that from the maturity. If at all you did not claim deduction of the premium, reduce it from the maturity, balance only taxable. For each policy base you calculate. No need to apply this clarification. So with this, other sources. Remember, received under ULIP and Keyban insurance policy, they are always received under ULIP and Keyban insurance policy. For them, separate taxation is there. For Keyban insurance policy, it is always taxable. For ULIP, separate taxation is there, which is not discussed at CA interlevel. Then we have one more amendment, which is 115 BBJ. 115 BBJ. This 115 BBJ is regarding winnings from online games. So we have already 115 BB where lottery, gambling, betting, any other game of sort, horse races, winnings, all these are taxable at 115 BB straight away. 115 BBJ. In order to understand 115 BBJ, 194 BA is also to be understood. But before that, sorry, one more provision I want to introduce related to insurance policy. By the way, insurance company, when they're releasing maturity amount, they should also deduct TDS. On which maturity amount? If at all the policy is exempted under 1010D, no TDS. So insurance company, when they're releasing maturity amount, they need to inquire, they need to get the data from the SSE, whether the amount which is receiving is taxable or exempted. After deciding that, they need to deduct TDS accordingly. Suppose if the amount which they're receiving is taxable for SSE, insurance company has to deduct TDS at 5%. 5% on the income portion only, not on the maturity amount. In institute material or somewhere I've seen problems, they have deducted TDS on the sum assured. Only income portion. Income portion means what? Whatever is taxable for the SSE under other sources, that is only called as income portion. On that only 5% TDS. However, if the aggregate payment made, if the payment itself is not exceeding, only if the payment is exceeding 1 lakh, TDS will apply. If at all payment is not exceeding 1 lakh, less than 1 lakh, no TDS under 194 TA. Clear? So we discussed the ATC point, we discussed the 1010D point, we discussed other sources taxability point, we even discussed the TDS point. Now let's look at the final amendment, that is 115 BBJ. Winnings from online games. For this, what I will do is, instead of discussing here, I will discuss it as part of TDS amendments related video. Getting it? You just continue watching this. You in the marathon or even the amendments class, the timestamp on TDS is there you will get it. Getting it? That's it. With this, other sources related amendment is over.